Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, June 17th, 2020. I want to start out with an update on the broad markets, take a look at the futures here real quick. I did put some charts out this morning. I'll follow up with that. And then I want to take a look at the daily chart of the S&P 500, point out a couple developments there, things that I'm watching. And then I'll talk on real quick, and I'll tell you right now in the beginning of the video as far as updates on gold, silver, Treasury bonds, even a lot of the agricultural commodities, things that I cover fairly frequently. There's really nothing to update. They are most of those are stuck within trading ranges like Treasury bonds, gold, silver. So there haven't been any significant updates, and there's really no direction that to a trend to trade right now. They're kind of stuck in those multi-month sideways trading ranges. So time permitting, I'll hit on those charts real quick. I just want to let you guys know that the analysis is light. What I tend to do is focus on and highlight things that have trading opportunities. I'm always going to do updates on the broad market. That's just part of everything. You'll get near daily updates there. But other things like crude oil, Bitcoin, for example, it's another one just kind of stuck in a trading range recently. I'll tend to highlight those if and when there's a setup forming, potential trade or potential breakout. Looks like it may be building or pending, I should say, pending a breakout, or if something has recently broken out and then it's an actionable trade. That's when I tend to jump on something and post frequent updates. Okay, so all right, let's dive into the chart. So I posted this morning, here's what we're watching on the S&P 500 futures, ES, these are the S&P E-mini futures, and so we formed this little uptrend line the last few days here, and we're testing it right now, and I think a break of that trend line. You can see we also have support just below about 31.14, a solid break, not a little limp down. You sometimes get these little candlestick breaks down there, but I think a break below will take us down, and I'm still favoring that right now because of the bigger picture, which I'm going to get to here in a second, the daily chart. So you can see some of the near-term targets right here with arrow breaks denoting the likely reaction points, something like that. Now, should we rally higher? As you can see, this is still very significant resistance, as I mentioned this morning. This right here, this boxed in area, is the island cluster top on the SPY that we'll get to in a minute. That's where we put in that island top. And so that really represents that gap. If we make a full backfill of the gap. Remember, yesterday, both QQQ and SPY entered the gaps, but failed to backfill, which is... I'm not going to chalk it up as super bearish, but it's a bit bearish because usually once entered, a gap will be backfilled, especially when you get about halfway through. So the fact that the bulls or the buyers were not able to continue that rally and backfill those gaps, and the fact that we closed back down at the bottom of those gaps is a tad bit bearish. But once we break down, if and when, then we'll have a rejection, a failed attempt, and those gaps will have proved to be resistance. We'll get to that in a second. So there it is. We're starting to crack on ES. There's NQ starting to crack there as well. NQ, already has divergence. ES had it the last time around. ES would have to push up, and we'll go back there in a second. Push up a little higher to put in a divergent high. But there's a nice little wedge there. Remember, we had a divergent high there. Had that quick drop, hit the minimum target I outlined in that video yesterday. Bounce from there. And that was support. At the very least, you expect a reaction off a well-defined support level like that, and that's what we got, a reaction, a bounce, and pushed up, made a marginal new high, and then pretty much parked it right there yesterday where we were. We started the day here right around that, call it 10,000 if you want, and I have it at 9997 on NQ, and again, resistance there. So that's it. We're starting to crack, but not impulsively yet. Any more downside should build up some momentum. And again, let me just go back to ES and we'll move on. ES, as I said, could, if it can hold this support, could push up here, and that's going to be significant resistance. And if it gets up there, like I showed you this morning, I was just trying to draw those lines out. I extended these divergence lines. We did have divergence right here, and that led to that sharp drop. And any new high now, if we take out that previous high, that would be coincide with a backfill that gap. It could look like this. Put in just a little bit larger wedge, extend the divergence, and then you'd want to see, well, you could make an objective short on a backfill of the gap. Number one, that's resistance with a or that at least on ES at 31.75 with a stop somewhat above. Allow for a little stop pop. Maybe wait for a solid 60-minute close above, and or your next sell signal after that would come on a break this trend line. If they do any much more than that, then they'll backfill a gap, and then some get in this island. They'll probably make a run at the highs, the previous highs in the ES right here. Okay, SPY, and I'm keeping new trade ideas, official trade ideas, very light right now. Even this, is not an official trade idea. We had those big sell signals the other day, but we had a pretty strong snapback rally. But what I wanted to talk about is that. So there it is. We had the island cluster top right there with a big gap down. We're still well below the bottom of the island. Technically, the gap is up here. The bottom of that gap, or the top of that gap. So again, we're in the gap right now, right about the bottom of it. So you have this the top of this candle here. There's the bottom of the gap, give or take, right here. So now what I wanted to share, and I hadn't pointed out yet, is we had the sharp move down and a pretty sharp kickback rally over the last couple days. But as I said, the day of or the day after that drop right there, that was a very, very large drop. The red candle itself is big. If you add the gap, that's really what you're looking at. In other words, prices gap down, so that's where we close there. That would be, if you had, let's say, if this was trading 24/7 like the futures, that's what that candle would look like. So a pretty powerful move. And as I said, it is rare to see a drop that big come within an uptrend. You go back in time, which I did there, big red candles like that, and you can go back for years. Look at, pull a candlestick chart of the SPY, put on a daily time frame. You usually only see those type of candles during strong corrective phases. They don't come during an uptrend. Now look, this is a wonky market. It is, the Fed has as heavy a hand in the market as they've ever had in history, times, at a magnitude of what they were doing even back in 2008, which at the time was unprecedented. So, this is kind of the new norm now. These big moves, this super sharp rally off the lows, and as I said, and the most importantly is everything is relative. These big moves that we've had recently, and the big moves down here are relative to the the scope of this bull market. The Fed has created a bull market, and you go back on a weekly chart that goes for many years. It was a excessive, liquidity injected into the system, artificially low rates, near zero interest rates for years, and that's what happened. So you're getting these bigger and bigger shock waves, if you will, or corrections along the way. And right now, as I've been saying, you can call that a bear market. It certainly met the 20% drop definition of a bear market. Or you can just say it's a big corrective wave so far. That's what it kind of looks like here. And you still have this big megaphone pattern that I've talked about on SPY, and that's a weekly chart. All right, but let me loop back and show you something that kind of just puts things in perspective, at least for me. So we had that, what I considered excellent sell signal last week. We've had a pretty convincing bounce so far, but that sell signal is still intact. Both those, there were two sell signals: the gap down to put in the island cluster top, and the trend line break right there. So sell signals were intact, and there's even a trend line here you can see off the lows right here. Let me darken it up a little bit so you can see that trend line right there. So by all accounts, we've broken trend. Now, thing is, we're still in an uptrend, so I don't know if that makes sense to you. We've broken the trend lines, but the uptrend is still intact for now, for the time being. And that is, an uptrend is simply defined by a security making a series of well, let's do it this way: higher highs and higher lows. That's what we've been doing, walking up. And so far, this is a higher low right here. When will that uptrend begin to be called into question? When we take out the bottom of this trading range. That's the last major reaction low right here. So that's really when you can say, wow, or at least, hey, we're no longer in a confirmed uptrend anymore at that point. Now, what I wanted to show you is talking about that kind of sell signal and this kickback rally here. Let's turn off all these annotations, and let's just look at the three big drops in recent years that we've had in the market. I'm going to park these other indicators up here. We don't need them, so we'll make a little more, take advantage of the real estate on this screen here. And so you can see what we're going to look at here are these three big drops. In 2018, we had that big drop into the lows there. Of course, we all know we had this big drop here into the March lows, even bigger. And so let's just look at the nature of those drops, how they started and how the first kickback rally played out. So we're going to start here with this one, and you know what I can do is zoom in a little tighter for you and show you what I'm going to do. So we can see the first leg down was right here. Initial leg down, pretty impulsive. Again, big red candles, that's where those come from. You usually see those in these kind of, corrective phases. And then you have, like always, you're going to have counter trend rallies. So let's try to measure that one. And again, I talk about things always being relative, and that means relative in percentage terms, relative to the scope of the move. And so the best way to gauge, let me grab a clean board here 1 second. Okay, I think this one will work. The best way to gauge, how powerful the move was is put up some Fibonacci retracements. So what I'm measuring from the highs right here down to the lows, that first kickback rally you can see stalled out. You can see the Fibonacci numbers here. These are in percentage terms. It stopped between the 32 and 50% Fibonacci retracement. Again, measuring from the high right there. You could look at that peak as well. It's going to be roughly the same. That stopped at about the 50% Fibonacci retracement right there. And again, I'm looking at this first kickback rally that was just a counter trend rally, and it was impressive in percentage terms. It was almost better than 4%, almost 5%. Now let's delete that one and go on to the next one here. Let me zoom in a little tighter, and now we'll look at the last big drop here. Do the same thing. Remember, much larger drop, so the magnitude of these, or the percentage drop there and the percentage kickback on the rally, well, it was much higher. That was about a 10% kickback rally, and it was just in 3 days from the lows, less than 3 full sessions, to the highs right there. It was better than a 10% drop. And you can see that one rallied right up here. There's a 50% Fibonacci level almost to the button right there on that drop. So now let's just move these fibs over here to this most recent correction. And you can see from the lows that came on, was Monday, right? Yep, Monday morning's lows. We rallied right up to the 61.8% Fibonacci retracement. Now, those are your typical retracement levels for counter trend moves, typically for between that 38.2 to 61.8%, 61.8% retracement. And so, point being, as impressive as that gain was over the last couple of days, it's really run of the mill for what, in hindsight, I'm sorry, when we go forward, we'll only be able to tell, as time goes on. But as of now, it appears to be nothing more than a counter trend rally. Again, time will either prove that to be true or not. If we rally up and take out the island cluster top, then that's more than just a counter trend rally. It was just a correction within the ongoing trend. Other than that, it's still, and again, based on the powerful sell signals, a large drop there, and normally not seeing that in an uptrend, I'm still viewing this as a counter trend rally at this point in time for that and all the other reasons I just explained. Okay, now what point is it no longer a counter trend rally? As I said, if we take out the top of the recent island cluster, but the things that to keep the bearish case alive and intact, obviously you don't want to see the gap more than backfilled. If they backfill the gap, that's normal. Gaps once entered usually are backfilled, and you'd look for rejection there. Anything much more than that, especially move above the island, as I said, kind of pretty much erases everything that happened last week. Will still keep us below the trend line. That's the other thing to watch, and we can still rally up here, make a new high, and if we do so, you can see down here on the indicators what you're going to have is, for the first time in a while now, you'll have some negative divergence if it happens soon. Again, it's all if and when it happens, because these indicators are lagging behind. You can see here on the PPO, I have to expand it out a little bit, making a considerably lower high. There's our previous high, and there's a previous high on the SPY. So any marginal new high anytime soon will be a divergent high, and also has the potential to backtest that trend line. So try to quantify it for you. What would be the upside potential from here should that scenario play out? Let's move this trend line away. It all depends on if and where you reverse, but we're talking maybe another 5% or so in the S&P 500 for a back test of the trend line, then put in these divergences if it happened over the next week or so. Again, I'm just trying to guesstimate and project there. That would be actually that'd be a couple days. It would I'm holding that line. That's about 2 days. That'd be about 3 days to get there. And again, in percentage terms, it'd be about 5-6%. Not my preferred scenario. I think because of these sell signals, everything I just said, I think we're probably going to head on down soon and take the next wave down. And what most likely started here with that sell signal, a new downtrend. Okay, other things to watch. Crude's become a little more tradable. Gold, like I said, gold, Bitcoin, Treasuries, they're kind of locked in trading ranges. But crude, as I showed you on the charts last night in the end of day update, I did a few static chart screenshots instead of a video. Crude's been trading very much in line with the stock market. In fact, when NQ broke down and hit that target yesterday, it wasn't mere coincidence. We had almost an identical trend line here on CL. We're looking at crude futures. They broke down too and also hit that support. So that's the bottom of that support zone is about $37. It's right there. You can see several reactions here, a reaction low there, reaction high right here, and we traded through it there, and of course that most recent reaction low. So that's the level to watch. So if the stock market breaks down, which as I'm doing this now, we now have those sell signals that I started to talk about earlier. We've broken this trend line, ES and Q, sell signals confirmed. Those are pretty impulsive candles. And so now I suspect crude will follow. And but if you want to play it safe, you wait for a break of 37.02. Being that it's so highly correlated with the stock market, I think you could take a starter here. Maybe some of you might have taken one there yesterday, and then add to it once 37 goes. And again, that's the next target zone down here. I'm going to give you one more level if you're an active trader, since that's what this market's been more conducive to lately, is active trading more than swing trading. Both the markets and crude oil here, you can get these little rips and dips. So there's your first target. 37 goes, 36 would be your first target, and then this is another support zone down here at about 34.43 up to about 34.76, and that'd be a pretty nice drop in crude if and when it gets there. And if things really get ugly, we could head all the way down here, potentially down to that $31 level. Should the market turn around, rally up, and take out the recent island cluster, then you're probably going to see crude move up in sympathy with the stock market. Here's TLT, long-term Treasury bond ETF. These are 20 to 30-year Treasury bonds. It is below this support level here, but it's kind of chopping around. Not as clear to me as the futures. When I look at ZB, let's look at Treasury bond futures. There we go, and this is what I was talking about, being boxed in that multi-month trading range ever since the big, the volatility back in into the March lows right there, where the market, Treasuries, everything was going haywire. Treasury bonds have stabilized and traded in a pretty large but pretty well-defined sideways trading range. We had a brief dip below recently, and then we regained that range, and we're right back at the bottom of it now. So again, Treasuries are at support. Could go either way, but at the end of the day, it's not been a very, certainly not conducive to swing trading when you're going sideways for months. And active trading, maybe if you break that level again, or you go long here for a ride back to the midpoint of the trading range right there, that'd be your first target, and potentially a move up here. And if that scenario would mesh with a correction in the stock market, if these sell signals that we had last week remain intact and we are about to take another leg down, then this would be your most likely scenario for Treasury bonds, because they are a risk-off asset. Like the other risk-off asset, gold. Let's take a look at that. Let's dig up that chart right here. There we go. Same thing. Multi-week trading range. This is why you're not seeing a lot of updates on gold lately. Multi-month trading range goes back to early April. And again, you can't squeeze water from a rock, blood from a stone, so there's really not a trade to be made. Even silver, we had a trade on silver recently with that divergent high that moved down here, but it's kind of grinding around sideways as well and not giving us any clear direction. So it says one thing, that the market's rallying falling and it's not far off, all-time highs, and yet gold and silver are holding up. So it shows that they're pretty resilient. Normally you'd think you'd see more money coming out of those because it's a risk-on environment right now, and it has been for the last few weeks, an extremely risk-on environment. Yet these risk-off assets like gold, silver, and treasuries, they're not going up, but they're not going down either. They're holding up. So that says maybe should we get a decent correction coming soon in the stock market, that would certainly leave the potential for these guys to break out. However, if the S&P 500 takes out the recent island cluster tops, makes a run for new all-time highs, takes out the previous all-time highs, you will probably see money come out of the risk-off assets, particularly gold and treasury bonds. And silver is going to follow gold, give or take. And then finally, again, I just want to mention, Bitcoin as well. When Bitcoin, we've had a lot of trades on that, a lot more unofficial trades on Bitcoin and the Bitcoin proxies. You got to be patient. You wait for moves like this. You look for levels like this. You had a well-defined support line. You look for a break. There's a move. You look for a divergent low that put in a major bottom followed by this rally. It's not shown here, but you had the divergent high right there that set up this move down here, divergent low. So Bitcoin is a great trading vehicle. Whether you believe in it, I don't know enough about it or believe in its long-term viability, but it doesn't matter to me. Anything with a ticker you can trade. I don't care about the fundamentals. But what's gone on lately, I just want to point out, this is, by the way, a daily chart. Usually I'm looking at 60-minute charts when we're on this charting platform. This is a 2-year chart using daily candles right there, you can see. And here's the story on Bitcoin. It's kind of been slogging around sideways for months now. Does have, let me put that chart. There we go. I should say and mention and point out here that we are starting to diverge a little bit. That last high there, that spike high, was a divergent high. And it broke down below this trend line I have here, but it also came in, it took out this trend line here and back tested. So if you can see what I'm talking about, we're kind of pinched between support and resistance. Bitcoin can be and often acts as a risk-off asset. People moving money into this because it's an alternative form of a currency, if you will, or store of value, or whatever you want to call it. But it's kind of a messy chart, and if I had to pick one of the two based on the divergences, I'd say to the downside here. But again, here's the bottom line. This is our trading range here, so I don't see a high probability trade. If anything, I'd probably rather be short than long right now, but I don't have a position. And if it breaks above there, that would be pretty bullish. 10.854, and probably a little more downside here should open the door for a move down to these levels here. I don't have, I'd have to sharpen my pencil and give you additional targets, but let's just move on from it because I don't see a, like I said, a high probability trade with, very good risk reward profile. I'm going to wrap it up here, get this out to you guys. There are other things I'm watching, and I'll do updates on the agriculture commodities soon, and anything else that stands out. For now, kind of just wait and see where the market goes, see if we have any more follow through on those sell signals that just triggered after I started the video, and we'll go from there. You can see the support levels below that need to be taken out to really open the door to a bigger move down. This has been Randy Finney with Right Side of the Chart. Hope you enjoy.